Now if you look at the P&L of this company, we have a profit after tax of 60 and a dividend payout of 24. So apart from the other data, we also keep this data in mind and look at some of the other aspects of this ratio. What is known as earnings per share, that is for every share that the shareholder has, what is the earning. So which is nothing but for the shareholder, the profit level is the profit after tax, that is what belongs to the shareholder, and the total number of share outstanding is 32 lakhs. So the earnings per share is 1.875 through this mechanism. Remember, this earning per share is already achieved. That means it is based on the past data of the company, past profit after tax of the company. The past could be the last year earnings, or it could be, since many companies announce earnings every quarter, especially those which are listed in the stock exchanges, they are compulsorily required to announce earnings every quarter. You can take the last 4 quarters earnings and arrive at as to what the PAT figure is and divide it by the number of shares outstanding. So every 12 months or 4 quarters earnings per share also can be calculated. Out of this total earnings, certain amount is paid as dividend. So what accrues to the shareholders is the earnings per share, of which a certain part is paid in cash to the shareholders. That is the dividend per share. So the cash portion out of the 60 which was earned was 24 divided by the number of shares is 0.75. So out of 1.875 of earnings per share, 0.75 was paid out as cash to the shareholders, and the balance, which again belongs to the shareholder only, has been put back into the company, because the company in all probability believes that it will be able to earn a reasonably good return on that money, and it need not give it back to shareholders. A part of it can be given for reasons such as shareholders may require some cash coming in for liquidity and other purposes. So the dividend cover, how many times does my earnings cover the dividend? So earnings per share divided by dividend per share tells me that the dividend is sufficiently well covered. As a policy, if you take a trend over time, you will see that how many times the earnings per share is covering dividend will give you a comfort that you can expect certain amount of dividend to be paid out. That means a certain amount of return coming to you as a shareholder from time to time, because the earnings are covering the dividend in a reasonable manner, in this case 2.5 times. The other is what is known as payout ratio, which is what is the out of the total earnings of 1.875, 0.75 has been paid out. So total earnings that belong to the shareholder on a per share basis is 1.875, of which in cash 0.75 is paid out. That is called as payout ratio. So 0.75 divided by 1.875 tells you 0.4 or 40% of the total earnings in that year which belong to the shareholder has been paid out in form of cash. The balance 60% has been retained to be redeployed in the company, which in turn will generate hopefully higher return, which again belongs to the same shareholders, assuming that they still hold the shares. The next key ratio that we will look at is called earnings yield, which is your earnings per share divided by market price. If I as an investor I'm going to buy the share today at 22 rupees 50 paisa, I will want to know what is the EPS the company is generating. That is earnings that the company is generating. It is 1.875. When I divide that by my market price at which I am going to purchase, then I get earnings yield of 8.3%, which means I have a benchmark with which I can now look at and say that if I am putting 22.5 rupees per share, it is giving me an yield or earning of 1.875, effectively giving me 8.3% return. Now some of this may come to me by way of dividend, some will get redeployed, but the overall return this money is going to generate for me is 8.3% based on my past earning per share. That is my the basic minimum I expect. Now I can compare this and say that if I put the same amount in say fixed deposit in a bank, if it is going to give me say 9% or 9.5%, then I will have my own question mark about putting money into this company, which is giving a earnings yield which is much lesser. But remember, this earnings yield that I am talking about here is past. It is possible, it is very much possible that the investor who is putting in money expects this EPS to grow much faster in the future years, thereby giving much higher yield than 8.3%. Now, this is a call based on analysis of that particular company and industry the investor will take. Out of this 1.875, we saw 0.75 was paid out in cash. So, if I were to purchase this share at 22.5, what is the actual cash yield or dividend yield I will get? Out of the 8.75, 0.75 or 40% was paid out. So, my yield based on actual cash receipt. So, this belongs to me totally as a shareholder, of which I got 3.3% in cash and the balance got back into. So, if I am happy, or if I am an investor who is dependent on income, where I want more income to come in, I may not be very happy. But if I am an investor who is willing to wait for the company to grow and redeploy the amount to generate much higher returns, then I can do myself. If I put it into an FD or something like that in the bank, then I would be very happy to receive a lower cash outflow and look for the company to put money back into the business of the company to generate much higher return than I can do myself. So, that is the kind of logic that an investor might want to use. So, it depends upon the investor's position, where cash need is higher, or he or she does not mind waiting for the company to use it to create higher returns, which in turn will reflect in the share price. The third ratio, very important ratio, very popular ratio, is what is known as the price earnings ratio or the PE ratio. Now, this is, if you see, exactly the inverse of earnings yield. It tells you what is the amount an investor is willing to pay for every rupee of earnings that the company is generating. So, in this case, 1.875 is the earnings per share, and the share value is 22 or 22.5. Based on that, we arrive at that the company, for every rupee of earnings, the investor is willing to pay 12 times that as the share price. Now, this actually is basically a reflection of the future growth potential that the investors have. We have a video that we will show shortly, which will give you an idea of a much more greater insight into how this reflects the growth of the company, and how this is also used for comparing different companies in terms of the value of the share. And the last part is the market to book ratio, which is basically the market capitalization. If you remember, market capitalization is nothing but market price multiplied by the number of shares outstanding. When you multiply that, you get 720 lakhs divided by the book value, which is 360 lakhs. So, it is 2 times, as I said before. So, therefore, the market is expecting a good growth in the company's accretion into the reserves. That is, the profits are going to be pretty high, and they are going to be retained because high returns are being generated by the company, and therefore, it expects that retention of profits will be at a much higher pace in future. And that future, it is trying to, the investors are taking a call, making an assessment of that future, and trying to say that because of this growth that will happen, I am willing to pay a higher price, and therefore, the market cap is higher than the book value. It is a question of your understanding the industry and the company and its past performance to say, is 2 times something that is rational, is it something that the company can achieve, or it can go up to even 3 times, in which case you do not mind buying it even at this price. But if you feel anything over 1.5 times is ambitious, I mean, that is a relative analysis of various investors, then you may not want to invest in it. So, this is the kind of analysis the investors do to look at the various aspects from which they can value and look at the quality of their investment.